So, Andrew, we've got the US market reopening today. It was closed yesterday for Labor Day, that Labor Day holiday. But overall, it seems that we've got more weak data out of the States today. We had all that weak data from the manufacturing sector in China and Europe yesterday, and disappointment around the Fed. How does this all play into what's playing out in the sectors here in South Africa?
Yeah, I think a key thing as well is the ECB meeting tomorrow. I think markets are a bit softer. They're waiting for news on that. I think some sort of plan needs to be revealed. Investors can't keep hearing no real plan coming out of the ECB. So I think that's a big factor playing on the markets at the moment as well. Manufacturing data out of China yesterday, as you said, was weak. Surprisingly, you saw the European markets increase the highest in a month on the back of expecting that maybe that will lead to some more stimulus, which is a bit perverse.
It does seem this divergence because we've actually had, Spanish and Italian bond yields slipping back today. 2-year bond yields down, 10-year bond yields down, and that is a signal of confidence.
Yes, exactly. And then also, obviously, the US manufacturing data that was out this afternoon. So there's a bit of negative sentiment, I think, around the markets, and we've seen that coming through in our market today.
And how exactly does that translate through? Again, we saw the weakness in the resources stocks that we saw on Thursday last week as well, and plenty of warning that the country risk for South Africa has certainly been highlighted with the Marikana event and fears amongst global investors.
Yeah, obviously resources have been the sector that's been hit the hardest, especially with China or fears around the slowdown in Chinese growth. What was very surprising was how easy the market moved past the Marikana tragedy of 2 weeks ago now. It didn't really, falter. However, if you listen to Jan Nelson, the CEO of Pan-African Resources, the other day, they needed to raise capital. He said they could only do it in South Africa. They couldn't do it abroad because South Africa is seen as investor unfriendly at the moment. So yeah, that's isn't good news at the moment.
Let's drill into results today. Steinhoff, in fact, is slipping back after releasing its full year results. Now, just looking at, running through the numbers, you've got revenue, which is up 87%, operating profit then increasing by a smaller margin, and you run through to headline earnings per ordinary share, only increasing by 7%. What did you make of the numbers, firstly?
I thought the numbers were quite good. Obviously we had the trading update last week. When you look at, we obviously prefer to look at your headline earnings numbers. You're looking at diluted headline earnings per share, they're up 20%. So from that perspective, we were quite happy with the numbers out of them.
So, I was speaking to Marcus Jooste, and he was saying going forward, the focus after all this restructuring, after all this kind of acquisitive, acquisitions they're basically making, and of course, Conforama in Europe is the biggest one. It's time now to really bed down acquisitions and reduce debt. Debt sitting at 1.3 billion. It's increased the EBITDA the EBITDA, covered by that is sitting at 7.1 times. It's increased. What are your thoughts on the debt position of Steinhoff right now? And is it a risk that they're not going to be able to meet these debt covers?
No, I don't think that's a big risk. Well, it's not a big concern for us. We do like the share and we do hold the company. I think a bigger concern, if you're looking at the balance sheets, is the large amount of intangible assets that sit there. I think that's the major, not concern, but question mark area is what I'd call it. We're not too concerned about the debt. Steinhoff historically have been very good at doing acquisitions. The market might have got a bit fed up with capital raising every time they did an acquisition. This year they've done it, I'd say, a lot more cleverly, if there's such a word. They've done a really good deal this year. We've always kind of looked at them as a private equity fund that plays in the furniture space, and the deal that they did with JD Group, I think, plays into the hands of that.
So lastly, first rand, sitting at 27.71 rand. It seems that the market liked the trading update. And you've always got Michael Jordan on Twitter. He's one of the most active CEOs on Twitter, talking about now going into the business space and revolutionizing the business space. Yeah. Your thoughts on F&B within First Rand and the outlook for those two?
First Rand, yeah, very nice trading updates coming out today. Obviously, we don't know where those numbers are coming from, but I think you could be well assured that they're coming out of the retail banking division. They've had a slightly different strategy to the other banks. They're targeting current banked customers, Standard Bank's customers, Nedbank's customers and the like, whereas the other banks are targeting the unbanked market. So slightly different strategies to the other bank. I think from a quality perspective, if you're looking at the book, I think First Rand's right up there.
Andrew, thank you. That was Andrew Dittberner, Senior Investment Manager at Cannon Asset Managers.